Welcome to the deep dive. Today, we're really digging into a huge market, pet care. I mean, if you've ever spent way too long comparing dog food ingredients online, or just wondered how these big pet companies operate, this one's definitely for you.
Hmm.
We're focusing on Chewy, Inc., a major player, obviously. We've got their Q2 2025 results, the SEC filings.
Right.
Our mission, cut through all that financial jargon, pull out the key highlights, see what's up with their customer trends, their strategy,
Yeah,
basically understand the why behind the numbers.
exactly. And these documents, they really do paint a fascinating picture, not just the numbers themselves, but the strategy behind them for the quarter ending August 3rd, 2025.
Yeah.
Yeah, it's that interplay,
Yeah.
between the financials they report and what they're actually doing operationally. It shows how they're not just like existing in the pet economy, but really shaping it.
Okay, good way to frame it. So let's start there. Chewy's core business. We know them as basically the biggest online pet store in the U.S., right? Huge selection, something like 130,000 products.
That's right, from about 3,200 brands, plus their own private label stuff. And their whole pitch is convenience and really top-notch customer service.
So looking at these Q2 numbers, what really jumps out about their customers, their core strength?
Well, the first thing you see is that connection with pet parents is clearly strong. Their active customer base, it's up to 20.9 million.
Wow.
Yeah, that's a solid 4.5% increase compared to last year. And maybe more impressive, they added 150,000 net new active customers just in this one quarter,
Sequentially.
sequentially.
Yeah.
So it's not just getting new people. It says a lot about their marketing, sure, but also about keeping those customers,
Yeah.
turning shoppers into loyal ones.
Right. Because trust and reliability are huge in this market, aren't they?
Absolutely paramount,
Right.
especially when it's about your pet's food or medicine.
Okay, so more customers. But are they spending more? What about that net sales per active customer, the NSPAC? It's up to $591.
Yeah, up 26% or 4.6% year over year. And that NSPAC figure, it's really insightful. It's not just that they have more customers. It shows the relationship is getting deeper.
Deeper how?
Well, people aren't just buying one thing and leaving. They're folding Chewy into their regular routine, spending more over time.
Yeah.
It suggests customers are sticking around and, maybe consolidating their pet spending with Chewy.
So higher lifetime value.
Exactly. It speaks to the stickiness of the platform, the value people feel they're getting.
And that stickiness, that brings us right to the Autoship program, doesn't it? I mean, these numbers are pretty wild.
They really are.
Autoship sales jumped, almost 15% year over year to $2.577 billion.
Yep, 14.9% growth. Strong.
And here's the kicker for me. Autoship is now 83% of their total net sales. 83%. That's up from 78% last year.
It's massive. And you've hit on probably their most critical strategic element. It's not just a feature, it's their loyalty engine.
Their moat, maybe?
Definitely a moat. It creates predictable, recurring revenue. For customers, it's super convenient, never run out of food, right? Chewy nails that need.
I know that panic. Sunday night, no dog food. Yeah.
Exactly. So the fact that Autoship is growing faster than their overall sales and makes up such a huge chunk, it shows they've moved beyond just selling stuff online. They're a service.
Okay, but is there a risk? Relying so heavily on one program, what if someone comes up with a better subscription?
It's a fair question. Heavy reliance can be a vulnerability. But right now, given their scale, their operational efficiency, and how much customers seem to like it, it's a massive strength. It means high retention, lower cost to keep customers over time. It really backs up what the CEO, Somit Singh, said about their differentiated value proposition.
Makes sense. That convenience factor is huge.
Mm.
So, okay, loyal customers spending more, locked into Autoship. How did that all translate to the top-line financials this quarter, the headline numbers?
Right, let's look at those. Net sales hit $3.1 billion. That's up 8.6% year over year. And importantly, that beat the high end of their own guidance.
Always a good sign. Shows they're executing well.
Definitely.
Yeah.
And the growth was pretty broad-based, too. It wasn't just one thing carrying them. Hard goods, like toys and beds, up over 15%.
Okay.
Their other category, which includes services, things like that, up over 12%. And consumables, food, treats, still grew a solid 6.6%. So a healthy mix.
Okay, solid growth across the board. But growth isn't everything, right? What about profitability? I saw their margins looked better. Gross margin up to 30.4%.
Yeah, up 90 basis points from last year. That's almost a full percentage point improvement, which is significant.
So they're keeping more of each dollar they make. What's driving that? Are they just charging more?
It's more nuanced than that, actually. The documents point to a few key things. One is growth in sponsored ads on their site. Those usually have good margins.
Ah, okay, like retail media.
Exactly. Then there's the effect of Autoship making up more of the mix that brings predictability and efficiency.
Hmm.
And they also mentioned better margins in consumables and their healthcare business, which is growing fast.
So it's a combination of factors. Sounds like operational improvements.
Yes, deliberate efforts to optimize profitability, not just chase sales. It shows a maturing operation.
And that seems to flow down to adjusted EBITDA too, right? That was up
It
significantly.
was $183.3 million, up 26.5% year over year, and the adjusted EBITDA margin hit 5.9%, up 80 basis points.
And just remind everyone that adjusted EBITDA, it's a non-GAAP number, but it's what management often uses to see how the core operations are really doing, stripping out certain items.
Precisely. It gives you a cleaner look at operating profitability, and based on that, the core business looks healthy and improving.
Okay. But this is where things get a bit confusing, maybe. Because the reported net income, the GAAP number, that dropped massively, like 79%.
Yeah, 62.0 per million dollars in GAAP net income, down 79.3% year over year. And if you just saw that headline, you definitely raise your eyebrows.
Right. A 79% drop sounds terrible. But then, like you said, adjusted EBITDA is way up. And I saw adjusted net income was also up like over 34%. So
Yeah,
what gives? How do you square those two?
this is such a classic example of why you have to look beneath the surface with financial reporting. It really flags that question. How do we interpret this data properly?
Yeah.
The huge difference comes down almost entirely to a one-off event last year. In Q2 2024, they had a massive non-recurring tax benefit of $275.7 million.
Ah,
It
okay.
was related to releasing a valuation allowance on deferred tax assets. It's basically an accounting adjustment, not something that reflects how the business was actually performing day to day.
So comparing this quarter's GAAP income to last year's GAAP income is kind of apples to oranges because of that huge unusual tax item last year?
Exactly. It distorts the comparison. That's why looking at the adjusted figures is so important here. Adjusted net income was $141.1 million, up almost 35%. Adjusted diluted EPS, earnings per share, was 33 cents, up 37.5%.
Okay, so those adjusted numbers strip out that weird tax thing and give a much clearer view of the underlying business trend.
That's the idea. They show the actual operational profitability trend, which was strong growth. It's a really powerful reminder to always dig into the why behind a big percentage change, especially with job net income.
Absolutely critical context. Without that, you'd get a totally wrong picture. Okay, so the underlying business looks healthy. Let's talk about how they're investing for the future then. What about spending? SG&A expenses, selling, general, and admin were up 8.2%.
They were to $671.9 million.
Yeah.
And yes, that's a significant investment, but it looks pretty strategic when you break it down.
It's in there.
A lot of it is fulfillment costs, expanding their Houston center, building out their pharmacy network, basically investing in the plumbing to handle more orders faster.
Right.
They also mentioned higher labor costs getting ready for the holidays.
So building capacity, and they mentioned capital expenditures of about $66 million too, right, for facilities.
Yeah, $65.7 million. Directed at those fulfillment centers, new vet clinics, that's a big push for them, pharmacy, and infrastructure for their fresh and frozen private brands. These aren't just costs. They're investments in becoming a more integrated pet care system, not just a store.
Right. Moving beyond just shipping boxes to offering higher margin services, potentially locking customers in even more.
Exactly. It's about building out that ecosystem, especially with things like vet care being such a big trend.
Are they investing just in physical stuff, or is there tech investment too? I saw something about IT modernization.
Oh yeah, definitely tech too. They're working on a big project to modernize their finance IT architecture.
What does that mean in practice?
Better data, basically.
Mm.
More detailed financial info by segment, better visibility across the business. And this is key, integrating AI for more efficiency.
AI for efficiency. Interesting. So using tech to get smarter about operations.
That's the goal. And interestingly, they said they don't expect it to require significant new capital investment, so they're likely leveraging existing tech or cloud smartly. It shows a vision for intelligent scaling, using data and AI to optimize things long term.
Okay, so investing in physical capacity, investing in digital smarts. What about just getting new customers? Ad spending.
That was up too, but maybe more modestly. Advertising and marketing expenses rose 5.3% to $200.6 million. So still investing strategically there, but perhaps seeing some leverage as the brand grows and retention stays high.
Makes sense. And despite all this spending, their cash flow looked pretty good. Free cash flow was up.
Yeah, free cash flow was $105.9 million, up almost 16% year over year, and they ended the quarter with a decent cash cushion, about $592 million.
So they have the flexibility to make these investments. But it's interesting, they're investing heavily and they're buying back stock, returning capital to shareholders.
They are. They spent about $153 million on share repurchases in the quarter.
Including a chunk from an insider, right?
Yeah, $100 million repurchased from an affiliated seller, and they still have around $360 million left on their current $500 million repurchase authorization.
So it seems like a balancing act. Investing for growth, but also showing confidence in the stock price and returning value now. What kind of future are they signaling with this mix?
I think it signals confidence. They believe they can fund their growth initiatives, the fulfillment centers, the tech upgrades, the vet clinics, while also having enough cash flow and confidence in their long-term value to buy back shares. It's a sign of a mature, financially healthy company that's trying to do both invest for tomorrow and reward shareholders today.
Okay, a multi-pronged approach. So speaking of tomorrow, what does their guidance tell us? What are they projecting for the rest of the year?
For the next quarter, Q3, they're guiding for net sales between $3.07 and $3.1 billion. That's about 7-8% year-over-year growth.
Okay, and for the full year?
For fiscal 2025, they're aiming for $12.5 to $12.6 billion in net sales. They expect adjusted EBITDA margin between 5.4% and 5.7%, and adjusted diluted EPS between $28 and $0.33.
Pretty specific targets. But they also mention macroeconomic headwinds, right? Inflation, interest rates.
They did. They're very aware of the broader economic climate and how it could affect their business, and maybe more importantly, how it affects consumer spending habits. Even in pet care,
Yeah.
which tends to be resilient, people might change how they spend.
So how does a company like Chewy balance those ambitious internal plans with those real-world uncertainties? It seems tricky.
It is tricky. It comes down to execution and adaptability. Their internal engines, like Autoship and the investments they're making, give them some control. But they need to be ready to adjust logistics, maybe pricing, supply chain stuff, based on what's happening externally.
And that focus on AI and data probably helps there, being able to react faster.
You'd assume so. Better data should lead to smarter, quicker decisions. They also mentioned a regulatory thing, the One Big Beautiful Bill Act, or
Yeah.
OBBA.
Yeah, what was that?
It apparently made some key tax provisions permanent back in July. They're still evaluating the full impact, but anything that brings more long-term tax predictability is generally helpful for planning.
Right, reduces one source of uncertainty. So it's about managing what they can control internally while staying nimble enough for external shifts.
That's the balancing act, absolutely.
Well, this has been a really insightful deep dive. It feels like we've peeled back the layers on Chewy's Q2 performance.
Yeah, it's a compelling story.
You see the strong customer loyalty, that Autoship engine really humming, driving solid growth, and importantly, adjusted profitability. Then there are these big strategic bets on infrastructure, on tech, on AI, aimed at future scale. And they're managing capital smartly, buying back stock even while investing.
All while keeping an eye on that complex economic backdrop. It really shows their focus on, connecting with those pet parents and leveraging the resilience of the pet market.
It really does. It makes you think. We see these massive investments in fulfillment, in digital tools, and this incredible reliance on Autoship. It's all about becoming part of the customer's routine, isn't it?
Absolutely. Deep integration.
So maybe the real measure of success for a company like this in today's world isn't just how many customers you get, but how deeply, how indispensably you weave yourself into their daily lives.
That's a fascinating thought to end on. How integrated can they become?
Something for us all to chew on. Thanks for joining us for this deep dive.